Good afternoon, everyone, and welcome to today's briefing on FBT. My name is Ali Suleiman, and I am the Employment Taxes Partner at Pitcher Partners. In today's online session, we'll be providing you with an update to some of the FBT changes that have occurred during the year ended 31 March 2021 and reinforce some of the key FBT fundamentals. In respect of any questions you may have, you will note there's a dialogue box in your GoToWebinar screen where I encourage you to submit any questions that you may have. Time permitting, we will seek to answer these questions in the 5 minutes or so towards the conclusion of our presentation. If we do run out of time, again, we'll endeavour to follow up on those outstanding queries we have and reach out to you via email. In any case, we will also provide our email details to you at the conclusion of the presentation. So feel free to email us with any concerns, queries, or matters that you'd like to follow up with us if you haven't had the opportunity to post your question at the time of the presentation. Of course, you could always reach out to your regular PP contact or advisor as well. So before I begin, I need to point out some particular housekeeping matters. If we move to the slide on disclaimers, lawyers love this much more than us accountants, but nonetheless, in terms of housekeeping, the presentation doesn't purport to provide legal advice and is only general advice, which hasn't been tailored to your individual circumstances. We do ask that you please don't copy or distribute this presentation without our consent. And there are a few other important notes on that slide, and I will leave it to you in your own time to just review at your leisure. In terms of today's presentation, I will be joined by Gary Matthews and Elena Bogomolova, both highly experienced tax practitioners that specialise not only in FBT matters, but also other employment taxes such as payroll tax, work cover and superannuation. In terms of the presentation, there'll be a bit of a tag team today where I'll be covering off on the introduction, the basic concepts and key dates and thresholds, before moving on to Gary to discuss some of the recent developments, and Elena will bring us home with some common issues that we encounter with our clients. So hopefully there'll be some tips and traps coming out of each part of the presentation that you might find useful. So in terms of where to begin this presentation, and for those of you that may have attended this presentation last year, we discussed the fact that there was a bit of a perfect storm brewing. And I've written there, take two on the perfect storm. And that's because obviously COVID caused a bit of a pause to that perfect storm last year. In terms of what the regulators have been doing, particularly the ATO, they've been undertaking diverse data gathering initiatives. Because of the COVID-19 pandemic and disruption, many of the ATO officers actually put aside their normal roles and actually were getting involved in compliance work on matters such as JobKeeper. Now, with that coming to a close, they'll obviously be resuming their roles as their former roles and picking up where they left off in a sense. So in terms of data gathering initiatives that we could expect to pick up very, very soon, you know, you'll all be aware that single touch payroll was a big change that was rolled out to almost every single organisation and every single employer. You know, the ATO has access to data from superannuation funds, which they are able to match up with STP data, single touch payroll data, at least on a quarterly basis. You may be aware already that the taxable payment annual reporting was broadened and expanded to include further industries such as cleaning and courier services, road freight services. So there's a wealth of employee and contractor data that the ATO, at the very least, has at their disposal. And without just limiting it to the ATO, just last month, the ATO actually did announce they'll be undertaking a data matching program for motor vehicle registration. So that's obviously with VicRoads, where, again, this is nothing new. They've obviously been to this well before, and it proves to be very fruitful for them. Where they go to VicRoads, they request data and information about vehicles that may be registered by companies and other entities. And even though there's a vehicle registered in that company or other business name, there's no FBT return being lodged, for example. So it's an easy little match and work that they can undertake to to launch further review and compliance activities. And I did touch on information sharing there with VicRoads. Again, we both, Gary Allen and myself, we practice with state taxes, and the SRO have already been releasing letters to our clients, and they make no secret of the fact that they've been obtaining information from the ATO tax return disclosures, and they use that as part of the prelude to launching a review on why disclosures don't match up to what they would expect. So all in all, in terms of the perfect storm take two, for the last 12 months, we've had a rather compassionate and understanding tax regulator. My fear is that this will shift as you know, the employees within the ATO return to their normal roles. There's pressure that they may face to help broaden the revenue base, particularly as we all know we'll be facing some large budget deficits in the years to come and periods to come. So moving on to fringe benefits and fringe benefits tax and some basic concepts on our next slide. I really wanted to start with an understanding of what is a fringe benefit. And in short, it is a tax. It's a separate tax paid by employers. It's separate to income tax, and it relates to benefits provided by employers to their employees. What you should note is that the definition is very broad. So if we look at the section on the bottom there, in terms of fringe benefit, it's a fringe benefit means a benefit provided to an employee or an associate of that employee by the employer or an associate of the employer or under an arrangement facilitated by that employment relationship. So that definition of fringe benefit is rather broad, and it's broadened even more by the definition of benefit, which includes any right, privilege, service or facility. So as I noted, that definition is extremely broad, and it's capable of covering things such as salary and wages, termination payments, and even the receipt of shares in the employer by the employee. So why doesn't it include those things? It's because there are several exclusions within that definition of what is a fringe benefit. And we need to look to these exclusions to determine whether we fall within the Fringe Benefits Tax Act. I mean, I personally get a lot of questions regarding employee shares and FBT, and thankfully there is an anti-overlap rule where tax only arises under one regime. So if you have got an issue of shares by an employer to an employee, that prima facie meets the definition of fringe benefit, but it also meets the definition of an employee share scheme interest. And so where the two apply, FBT is switched off, so that where in the employee share scheme rules apply, then there's assessment only under those rules and not under the FBT rules. Probably the only other point to note is that in terms of fringe benefits tax, it is capable of applying not only to current employees but also to future or past employees. So that if it is deemed and determined that the benefit has been provided in respect of or in relation to the employment of that employee. So what is an employee? If we just return to the previous slide there, please, Eleanor. So what is an employee? How is it defined for the purposes of the Fringe Benefits Tax Act? It captures a person who's in receipt of salary and wages, and that leads to a PAYG withholding obligation. That's probably the easy part of the definition to understand. It also captures directors and director fees paid to directors, because there's a PAYG obligation that arises even in those circumstances. But there's also an extended definition of what an employee is, and it can extend to those people or those employees who only receive non-cash payments. So if you think of the example of a director who's not paid anything, and so there's no PAYG withholding obligation, but they are provided with the use of a company car, and all the costs of running that car are borne by the company. Notwithstanding the fact that there is no PAYG withholding under the extended definition of employee under the FBT rules, the director is captured as an employee, and the car being provided to the director in those circumstances will be subject to fringe benefits tax. The key thing to distinguish in cases involving non-arm's length employees, for example, if I'm a director, but also a shareholder in the company, or I'm a beneficiary of a trust that's running the business and doing the employment, is whether there's a sufficient or material connection between the employment and the receipt of the benefit. So put another way, if you look at the facts and circumstances, would they indicate that the person is receiving the particular benefit as an employee or as a shareholder or a beneficiary? And it is really important to highlight on that point, because if they are receiving it in their capacity as a shareholder or beneficiary, then they're likely to fall outside of the FBT rules. However, noting the private business context that many of our clients operate, that potentially puts you into other taxation measures such as Division 7A. But just really wanted to point out, what is the relationship under which you are receiving the benefit? There needs to be a sufficient or material connection between the employment and the receipt of the benefit. If we move along to the benefit categories, we've got listed there all of the FBT benefit categories. Now, as I said before, the definition of FBT is cast wide and includes things like motor vehicles. It includes car parking. It includes the provision of loans. It includes the forgiveness of loans in terms of a debt waiver. It includes the provision of meals and entertainment, and living away from home allowances. And just in case it doesn't fit under a particular category, but there is a benefit, right, or privilege or service being provided, then it could fall under the category of the residual benefit as a bit of a catch-all. So the net is cast particularly wide if a benefit is being provided to employees. It will be returning to some of these categories in a bit more detail shortly, as Gary and Alan will talk about some of the recent developments and some of the common issues that we've been observing in this space. Now, in terms of why are the categories potentially important, the importance of that comes out to bear in determining what is the taxable value, because the differing categories often have different valuation methodologies. For example, we've talked a little bit about a car fringe benefit. You know, if we're talking about a car fringe benefit that the employer is providing to an employee, whether it's via a novated lease or otherwise, if it is a car fringe benefit, then you've got the ability to use either the statutory method, where you can apply a certain percentage to the value of the car to work out the fringe benefit value, or the operating cost method, where you maintain a logbook. But that's if it's a car fringe benefit. The same thing might be categorized in a different way if it's the employee that owns the car and the employer reimburses some of the running costs, the expenses such as petrol and repairs and so forth, to the employee. In that circumstance, even though the expenses are ostensibly similar, the way that the arrangement has been structured, it will fall into a different category, being an expense payment fringe benefit. And to that end, different valuation rules apply, and it'll be a different taxable value that can be calculated. So it is important to understand what category of benefit for the purposes of valuation. The other factor that's really important to determining what is taxable value is whether or not there's an exemption available. And what we've got listed there on the slides are a couple of specific exemptions, or one specific exemption relating to the in-house childcare facilities. You know, you might have had some involvement or dealings with minor benefits, under $300 GST exclusive benefits that are provided irregularly or infrequently. That's another particular exemption that might be available. So that has a key bearing and an impact on exemption availability. And I think Gary may even touch on an emergency assistance exemption that might have been particularly relevant with in the last year or so. And finally, the taxable value can be reduced by things such as the otherwise deductible rule. So the otherwise deductible rule lets you consider whether or not the cost that's being borne or the benefit that's being provided, if that was a cost that was borne by the employee, would there have been an income tax deduction available to the employee? And to the extent that there is, then you are able to reduce the taxable value for FBT purposes. The other aspect, or the other way of reducing the FBT taxable value, is for the employee to make an after-tax contribution towards the value of the benefit. So effectively pay for the benefit being provided. So moving right along to some of the key dates, rates and thresholds. probably just wanted to, well, there's not a whole lot of change that's occurred in this area. FBT still has a slightly unusual year-end date of 31 March, which means, and then an ultimate lodgement if you have a tax agent being 25 June. So it doesn't give you a whole lot of time to organise your affairs and get your FBT return in for submission. If you're not using an agent, the lodgement date is May 21, so it is a little earlier. So there are advantages of using a tax agent in terms of that extra time in lodging your FBT return. What is now a permanent and I think a thankful change is that there used to be this requirement that 90% of your FBT liability needed to be estimated and paid by 28 May if you wanted to take advantage of the 25 June lodgement period. So whether you're using a tax agent or not, you needed to at least have tried to have paid 90% of your anticipated liability by May 28. With COVID, that was administratively granted as a concession, and that didn't need to occur. Now it's been legislated, and there is a permanent change that payment requirement has been removed quite from this year forward. So it's I suppose it's a welcome change. Moving on in terms of some of the key rates, probably don't want to focus on this. There are other more important and important aspects to follow on in this presentation. The FBT rate remains unchanged, which means the various type 1 and type 2 gross up rates remain unchanged. In terms of some of the charitable entities and other FBT rebatable or FBT exempt entities, the caps that are made available to their employees, they remain unchanged. In terms of some other rates, you can see there they've been adjusted slightly for CPI as well. So if you are providing a loan fringe benefit, for example, you might, whether or not you are providing a loan fringe benefit might be whether or not you're charging the benchmark interest rate, and you can see that's come down over the last 12 months, again, just reflecting economic conditions, and the car parking thresholds have increased as well. So look, that's all just data that we'll make available as part of the slides for you to review to keep as a handy reference. Don't really want to talk too much about that. I think the areas we need to focus on are some of the changes, and there are a few changes, and for that I'll hand over to Gary Matthews to take us through them.
Okay, thank you very much, Ali, and welcome everyone. Probably the first area that I want to focus on, if we go to the next slide, is in relation to COVID-19 and FBT. And I'm sure in your organisation there's been a lot of changes in terms of what benefits are provided and how they're provided. And the fact is that a lot of employees are working from home rather than working in the office, and there may be benefits provided associated with that as well. So it's probably an area that we need to focus on. We did actually send out a bulletin on this towards the end of last year, and I think Ali will agree we'll reissue that shortly. But there's a few key areas just to consider as far as how COVID and the lockdowns may have impacted on benefits. And the first one is in relation to cars. Now, the fact is you might have had a situation in lockdown where the employee had the car at home for the whole period, but was rarely travelling for work whilst that car was garaged at home. Or alternatively, you might have had a situation where all cars that were provided to employees were actually garaged at the employer's premises. And that's probably critical. If you're using the statutory formula method to determine a car fringe benefit, the fact that a car's garaged at the employee's home gives rise technically under the Act to a benefit on that given day. Okay, so even if the employee didn't drive it or only drove within the 5K radius, like we were required to live within for a period, the fact is there's still a benefit technically under the Act. So you can't then say it's not available for the employees of private use because they're locked down. It is technically a benefit. The only way to avoid a liability for a car in lockdown where it's garaged at the employee's home is if you're using the operating cost method or the logbook method. Okay, so I mean, that's a clear one. So I just digress slightly though. If the cars were garaged at the employer's premises for the whole period of the lockdown or a part of that period, then for those days, we can safely say there's no benefit provided. Okay, so as far as the statutory formula method is concerned, for the number of days that it was at the employer's premises, there's no benefit. If it's operating cost for the period, then we can say for that period, given if we've got, so long as we've got supporting odometer readings, we can say for that period that there was no benefit. So we can effectively apply a 0% business private use for that particular period. The problem is, though, when the car is garaged at the employer's home, as I said, if you use statutory formula method, you must deem and say that the benefit is provided for that period. If you're using the operating cost method, however, the ATO has said that if the car was garaged at the employee's home and was not used for business purposes during the lockdown period, and maybe only very minor incidental private use over that period, such as driving the car to, say, get serviced, etc., then they will accept that there's no benefit in that period if you're using the logbook method, the operating cost method. Now, also, if you're using the operating cost method, Eleanor, you're part of the screens across, yep. If you're using the operating cost method and you've got a logbook already, the ATO will also accept that your pattern of use may have changed for the period that you garage at home, because obviously you're not visiting clients, you're not doing the things in the normal way that you would have. The ATO will accept that there may be a change in pattern, so you can adjust the percentage of business use for that period, so long as you've got adequate odometer records over the period it was garaged at home, and you can support it through obviously relevant diaries and other information that the employee has. So that's if you've already got a logbook. You can also have kept a logbook during the lockdown period, but that has to be representative of the whole year's use. And I think there's going to be difficulties in being able to say that for a lockdown period and out of a lockdown period, it remains representative. Okay, but look, if you use the logbook method, certainly it's probably something that you should seek further consultation on, just to clarify how it all will work with these lockdowns, etc. Now, as far as car parking is concerned, if you had a situation where employees were working from home and didn't drive into the office, in fact, technically under the Act, under the actual method, there is no benefits provided for that period. Okay, for a car parking benefit to be provided, the employee must have at some point during the day travel between home and the place where the car parking is provided. If they just stayed at home, there's no car parking benefit, even though the space is available for their use in the office, say. If they left the car at the office for the whole day and not driven between home and work on that day, also technically there's no benefit. Okay, so that's relevant to consider. However, if you use the statutory formula method, technically you could be seen to have provided a benefit because you use a statutory formula, and therefore it's just applied, and there's no sort of grey to it. The only issue is if you went into lockdown before the start of this FBT year, before 1 April last year, the statutory formula method will only start on the first day that a benefit's actually provided during the year. So for the period up until the first day out of lockdown, the first time round, if they then travel to work, you could say that no benefits have been provided. Okay, but just be careful about car parking benefits, because, as I say, be very wary of the use of the statutory formula method, because it will deem benefits provided over a period where you may in fact have not provided them. So it might be the case that you're better off using the actual method. Okay, anyway, so there's a couple of considerations as far as car parking. Now, also, you may have a situation where obviously your employees were working from home, and in doing so, you may have either provided equipment to them to assist them in working from home, or alternatively, you may have reimbursed certain costs that they may have incurred in setting up at home. So it might be that you've provided paid for their monitor at home, or a chair, or you've loaned them the use of a monitor or a chair at home. Now, as far as FBT is concerned, a benefit does arise in either providing or reimbursing an employee for equipment. Okay, so if you provide equipment, however, the ATO has basically indicated that if you provided equipment for their use, the employee's use, and you, the employer, retain title to that property for that period, it will be considered not to be taxable under either minor benefits exemption or the otherwise deductible rule. So there won't be an issue. But if you've reimbursed employees for certain costs, potentially there is a benefit. Now, if it's under $300, we would safely apply the minor benefits exemption and say there's no taxable benefit as far as it's concerned. But if the benefit is greater than $300, we're going to have a problem. So if you've bought a monitor that costs, say, $500 for an employee or reimbursed it, and the employee gets title to that, then there will be technically a benefit. And because it's a depreciable asset, the otherwise deductible rule can't be applied because it can only be applied to one-off tax deductions, and depreciation is not considered a one-off tax deduction. So it does complicate things. So if you've done that, I would suggest you seek further advice on that area. Meal entertainment, there's likely to have been significant changes, especially over the lockdown period in terms, and even now, in terms of how you entertain both your employees and clients. The fact that you've used the actual method or the 50-50 method in the past may need reconsideration, just because the pattern by which you've been providing meal entertainment will have changed drastically. So really what worked last year and even all prior years may substantially change, and instead of the 50-50 method, you may in fact use the actual method because there's been very, very little entertainment over the year, and you could safely, so long as each event's under $300 per head, you could possibly apply the minor benefits exemption if you use the actual method and therefore not have taxable benefits. So it's worth consideration. Also, you may have provided emergency assistance to people, employees that needed assistance during the COVID lockdown periods, and potentially those benefits could also be considered exempt in certain cases. Again, if you did provide benefits, say like short-term accommodation, or you paid for certain items to get them through the period, I would suggest you seek advice on those. Okay, if we just move on to the next slide. Now, quickly, I don't have a lot of time to talk about this, but we have a ruling that's been issued this year, TR 2021-1, which talks about deductibility of transport costs. Now, the relevance of this to FBT is that in cases where you reimburse an employee's travel costs or transport costs, then there is a benefit, but if it's deductible, then it would be otherwise deductible for FBT. So it really does have some significance. This ruling replaces a draft ruling that was issued in 2009, and basically the concepts in this ruling are pretty much the same as what was in the draft ruling in 2019. You may recall there was an earlier ruling in 2017 which talked about concepts like coexisting workplaces and special demands travel. All of those concepts are out the door, and the ATO has pretty much simplified it all over again. So basically what we're talking about as far as deductibility of travel costs is that, basic concept is travel between home and an employee's regular place of work, and they may have more than one regular place of work. Travel between home and those places of work is not deductible. And that's a pretty basic concept as far as tax is concerned. However, if an employee is traveling in the performance of their employment duties, then it will be deductible. Now, traveling to a place of work is not performing duties. It's only once you get there and then travel from there that it normally would be the case. But there are other factors that we also need to consider as per the next slide. Okay, so as I said, your basic contact travel from home to work is not deductible. Even if you do incidental type work duties on the way in, say like deliver mail at the post office, or you're on the train and you check your emails on your laptop while you're traveling in, it's still going to be considered private travel, so it's not deductible. Now, also, the ruling makes the point that if you, as an employee, choose to live in one state, but your office is located in another state, then that travel will be non-deductible as well. That's basically you working according to your own personal choices. okay, and therefore that travel will never be deductible. The fact that you may pay an allowance to an employee to compensate for travel between work and home also does not make that travel deductible. The allowance will be fully taxable as far as we're concerned. Now, as I said, you could have more than one regular workplace, and it might be only a temporary workplace, one of those. But if it becomes regular, becomes a pattern over a period, such as our example here, where you are going to have to work from the Dandenong office for 3 days a week for 5 months due to a special requirement, that will become a regular place of work, and that travel will be non-deductible as well. And just be mindful that any expenses incurred in permanently relocating for work purposes, say from Melbourne to Sydney, that travel is not deductible for income tax and would be, but however, there are potentially relocation exemptions for FBT. So notwithstanding that travel's not deductible, it will probably, if it's travel to relocate to another state, say, it would normally be exempt from FBT. But here's some examples where it is deductible. So traveling from the office, say, to a meeting at a client's premises, or even from home directly to a client's premises for a meeting, would be considered to be a travel on work, and therefore that would be deductible. If you go from the office to another work location of the employer at the employer's direction, again, that's work-related travel, so that's okay. If you go from home, say, to a training session at a different location away from the office, again, that would be considered to be traveling on work and therefore deductible. If you live in one state and you work predominantly in that state, but say once a fortnight you have to attend a meeting interstate, that would be deductible travel. So again, that's not an issue. And if you reimburse it for FBT purposes, or the cost, or pay it, that would not be a benefit. And also in relation to fly in, fly out workers, a lot of these rulings, or this ruling and the next one that we're going to talk about, originated from a case, John Holland case, back in about 6 or 7 years ago. So if you've got an employee who travels, say, to a location to then travel to a remote site, so employees drive to the Perth airport where they then travel on to a remote work site, the travel from the Perth airport to that site would be considered to be deductible in certain cases, subject to the travel for the period that you're undertaking that travel from Perth, that the employee is under the direction and control of the employer. So that concept is still relevant as far as FIFO workers are concerned. But normal travel to a place of work from home would normally be non-deductible. Okay, if we just move on to the accommodation ruling. So we also had a ruling about deductibility of accommodation costs, and what's been issued is TR 2021 D1, which is a draft ruling on income tax and FBT and considers when accommodation, food and drink expenses are deductible. There's also been another guideline issued, PCG 2021 D1, and that considers the ATO's approach in determining if an employee is travelling on work or living away from home. Because whilst they may seem similar in the sense that the employee is travelling from their usual place of residence away, say maybe interstate, in one case it will be completely treated vastly different to another case, which I'll talk about shortly. Okay, if we just move on. So let's look at TR 2021 D1, and this is about accommodation and living expenses. Now, the general rule under this draft ruling is that living expenses are non-deductible, and therefore, if you pay them on behalf of an employee, they would be subject to FBT as well. Okay, and that would normally be the case if the expenses are incurred due to the employee's personal circumstances. I might live remotely because I choose to, and I travel to Melbourne and stay in Melbourne during the week. Now, the food and drink and accommodation costs will generally be considered non-deductible on the basis that that's my personal choice to live remotely. Okay, you also might have a situation where the employee, through the passage of time, is deemed to be living at that location. and therefore the living expenses will be non-deductible. So instead of traveling, they're now living there temporarily or permanently. Also, the expenses may be incurred because the employee has relocated their usual place of residence. Okay, so that relocation example, once you relocate, these sorts of expenses will be non-deductible. However, you can contrast that in this ruling where the employee is traveling on work. Okay, and if you're traveling on work, it's normally short-term travel. Okay, so in those cases, so like I've got to go to Sydney for 4 days, for a week, and then all the accommodation, food and drink will be deductible because I'm traveling on work and not through personal choices, etc. So we need to consider, you know, if they're traveling on work or if it's based on these other factors under the living expenses heading that would cause it to be non-deductible. Okay, now the practice compliance guideline, this draft guideline, determines the ATO's approach insofar as whether an employee is traveling on work or living away from their usual residence. Okay, so traveling on work, expenses deductible. Living away from their usual residence, living away normally would be non-deductible, albeit there may be FBT concessions. Now, one of the key guidelines has been that an employee will be considered to be traveling on work if they're away from home for no more than 21 days at a time and for less than 90 days in aggregate during the same FBT year, at the same location, that is. So I travel up to Sydney regularly. If in aggregate it's for no more than 90 days in the year, all of the expenses associated with me traveling up there and staying up there will be considered to be traveling on work and therefore deductible. But if it's 90 or more days, then the ATO has said in their practice compliance guideline that will be considered to be that I'm now living temporarily in Sydney and not traveling. Now, I should point out this rule is the ATO's view and it's not legislated. We do not necessarily agree with it in all circumstances. I really think that it has to be all situations have to be considered on their facts and don't just apply this in black and white. Okay, now if the 2190 test, so 21 days at a time, 90 in aggregate, has not been met, and therefore the employee is relocated, you can still consider the FBT living away from home benefits and allowances exemptions. So there's still some recourse where I've travelled to Sydney for more than 90 days, potentially we can still get some concessions for that. Okay. Just finally and quickly, just to note, and the next couple of slides don't actually apply to this FBT year, but will apply from 1 April 2021 onwards. Now, in fact, the government through the last budget that they announced that the small business turnover threshold to access exempt car parking benefits, the turnover threshold will increase from 10 million to 50 million per annum. And that's based on ordinary and statutory income. And it's based on the income derived by the business in the year ended 30 June that ends prior to the commencement of the FBT year. So when we're looking at the 2021-22 FBT year, you may pass a small business turnover threshold. If you've got turnover less than 50 mil, as at 30 June 2020, then you will qualify. Notwithstanding, in this following year, you may exceed that $50 million threshold whilst you're providing the car parking benefits. But if you meet the threshold test at 30 June 2020, any car parking benefits you provide on your premises, which are not in a commercial car park, will be exempt from FBT. So it's very much worth considering because there will be a lot of clients out there who will have had to pay FBT because their turnover's in excess of 10 mil, who may now qualify for this exemption going forward. Just be also mindful that this exemption does not apply to government bodies, public listed companies or subsidiaries of listed public companies. So it's there are some limitations. And just finally, before I hand over to Eleanor, there's a ruling that's been issued by the ATO. It was issued some time ago, and they've only originally it was going to apply from 1 April 2020, but due to COVID, etc., they postponed the commencement until 1 April 2021. And this ruling results from a case known as the Qantas Airways case, a car parking case that looked at car parking provided to employees at Canberra Airport. Now, basically what it's saying is that certain car parks that in the past the ATO have said are not commercial car parks will be considered to be commercial car parks, and therefore if you're within 1K of those and they charge in excess of the daily threshold, which is $9.15 this year, but will be probably around the $9.30, $9.40 mark next year, then you will have a liability for FBT, subject to those other considerations like the $50 million threshold. But so if you're near a shopping centre that charges for all day parking, if you're near the airport or you're near hospitals, just be very wary that if they charge in excess of that daily threshold, you will potentially be liable. Okay, so it's critical that you factor that in, because you could have been operating near a shopping centre in the past and you'd never been considered liable, because up until now the ATO said shopping centre car parks aren't considered commercial car parks. That will all change from 1 April 21, and you need to revisit that situation. Okay, well that's basically all I've got to say, and I'm sorry I've just probably pushed it a little bit past my time, but I'll now hand over to Eleanor, who'll talk about some common issues. Thank you.
Thank you, Gary, and hello, everyone. In my part, I will focus on common issues in areas of non-compliance, so relevant to motor vehicles, classification of benefits, living away from home allowance, entertainment, and exempt benefits. It's common amongst our clients to provide utility vehicles. Toyota Hiluxes, Amarok's, Nissan Navaras, Ford Rangers, we see it very often. And we often hear from clients, well, we provide utes and they're exempt. While this might be a case, what I want to stress, the exemption is not automatic. It is subject to satisfying certain criteria. We call this exemption a workhorse exemption. The workhorse exemption may cover vehicles such as utes, panel vans, dual cabs with carrying capacity either greater or less than 1 ton. For vehicles to be exempt, their private use has to be minor, infrequent, and irregular. What does it mean? This term is not defined in legislation, but there was a practical compliance guidance issued in 2018, PCG 2018-3. So this guidance discusses safe harbor rules and shows the ATO view in this area. So according to the ATO, minor, infrequent, and irregular use broadly mean that employees' private use is less than 1,000 kilometers per year, so very minor, and it practically means less than 20 kilometers per week. Employee doesn't make a single private return trip exceeding 200 kilometers, and when employee travels from home to work, employee doesn't have diversions greater than 2 kilometers. So I wanted to stress here that for the purposes of this exemption, when determining employees' private travel, home to work travel is disregarded and is not considered to be private use. What happens if the vehicles don't satisfy the workhorse exemption? The vehicles have to be valued for FBT purposes. So FBT will be payable on private use of these vehicles. And at this point, it becomes very important to determine the vehicle's carrying capacity. It is also known as payload. If the vehicle's carrying capacity is over 1 ton, it is a residual vehicle, and it has to be valued using law of operating cost or cents per kilometer methods. For those vehicles, there is no statutory requirement to keep a logbook. So a reasonable estimate of business kilometers and total annual kilometers traveled should be sufficient. When vehicles have carrying capacity of under 1 ton, they are car fringe benefits. And this is often the case with, for example, Toyota Hiluxes. For car fringe benefits, you must have a logbook to use operating cost method. Otherwise, you have to use statutory formula method. Importantly, when determining taxable value, home to work travel is considered to be private. Remember, for determining eligibility to workforce exemption, I said that home to work travel was disregarded. But for the purposes of valuing these vehicles, home to work travel is considered private use. So this is an important distinction, and we often suggest to clients to have 3 categories in their logbooks: business travel, private travel, and home to work travel, so they can calculate the taxable value correctly. Now, moving on to some common issues we see with car fringe benefits. First of all, when using statutory formula method, please remember the definition of base value. It is inclusive of GST, luxury car tax, dealer delivery charges, and non-business accessories, but is exclusive of stamp duty and registration costs. Sometimes an employer or employee provides a trade-in for the vehicle when they acquire a new vehicle. So those trade-ins may reduce the taxable value of car fringe benefits, but only where an employee provides a trade-in towards the purchase price of the car. Trade-ins provided by the employer do not reduce the base value of the car fringe benefits. If existing vehicles, for example, is transferred to a new employee, the base value does not change. The base value can only be reduced by 1/3 when the vehicle is held for 4 years by the beginning of the FBT year. When using operating cost method, please remember document keeping requirement. You have to have a valid logbook, and you have to have an election on file by the time of lodgement of the return. I wanted to touch on in relation to pooled and shared cars. Many fringe benefits are reportable on employees' payment summaries. When cars are pooled or shared by 2 or more employees, there is no requirement to report the benefit on employees' payment summary. But these vehicles are still subject to FBT. But what you need to be aware is that this reportable exemption is only applicable for car fringe benefits, and it's not applicable for residual vehicles. That is vehicles with carrying capacity over 1 ton. This is somewhat an oversight, I think, in the legislation, because at the time when it was drafted, residual vehicles were contemplated as being exempt. And now you can see that workforce exemption is much harder to satisfy. So be aware of this. Now, Ali touched on this issue of classification of benefits, and I just wanted to give you an example here. So when employee enters into a hire purchase agreement to acquire a $40,000 vehicle, and employer reimburses employee for hire purchase payment and car running expenses, which are $20,000 per annum. What type of benefit is that? For a car fringe benefit to arise, the car has to be owned or leased by the employer. In this case, the hire purchase agreement is in the employee's name, so it's not a car fringe benefit. As the employer reimburses the employee for cost incurred, it's an expense payment benefit. So the taxable value of this benefit is going to be $20,000. If it was a car fringe benefit, the taxable value could have been $8,000 using statutory formula method, so 20% of 40,000. Now, living away from home allowance, it's a rather complex topic. Basically, living away from home allowance, we call it LAFA, fringe benefits. They occur when employee is paid an allowance to compensate them for any additional non-deductible expenses incurred as a result of them being required to live away temporarily from their usual place of residence in order to perform their employment duties. Now, as Gary touched on before, there is important distinctions between LAFA and employees traveling for business. These distinctions need to be really well understood because they could give rise to completely different fringe benefit and completely different treatment. So for LAFA concessions to be available, employees need to be living away from home, which means they need to have a residence from which they're living away. So if you have an employee coming from overseas, it's unlikely that such employee would have a home in Australia from which he or she is living away from. Also, you might have employees who are living at home with their parents and don't own or rent their own homes. So the LAFA concessions are not going to be available for those employees. Now, employer has to collect declarations from employees to confirm that they're living away from home. And the concessional treatment for LAFA is only available for 12 months. If the project continues beyond 12 months, for example, LAFA becomes fully taxable. Now, there are some concessions and waivers provided to rotational workers who are on fly-in and fly-out arrangement, drive-in and drive-out arrangements. So 12 months rule and usual place of residence declarations are not required for those workers. So generally, LAFA can comprise of two components, payment for accommodation and payment for food. There is no set limit in relation to payment for accommodation, other than it has to be reasonable and has to be substantiated. For the food component, each year the ATO publishes reasonable rates. If employer decides to pay at a higher rate than the ATO reasonable rates, the excess is fully taxable. Now, let's move on to a fun topic, entertainment benefits. Now, this is somewhat complex area, and I can probably spend an hour talking solely on this topic, but in the interest of time, I'd like to focus on most common issues, and particularly given last year, which was largely affected by COVID, the entertainment benefits have been significantly reduced and changed in many organizations. So broadly, entertainment is a very wide concept and includes recreation, meal entertainment, accommodation, and travel to do with providing entertainment. And in order to determine whether or not you're providing entertainment benefit, you need to ask 4 questions: what, when, where, and why. The purpose of these questions is to distinguish when meal entertainment and when sustenance has been provided. It's important to differentiate between these two concepts, as the taxable treatment of meal entertainment and sustenance is very different. Sustenance is income tax deductible and can be exempt from FBT, whereas meal entertainment is not deductible unless it's subject to FBT. Now, as was mentioned previously, there are 2 main methods to value meal entertainment, what I've put together was this matrix, because what we understand from clients, a lot of clients have provided various gifts to employees in lieu of meal entertainment this year. So in these tables, I was trying to simplify the rules, but as you can see, by the number of ticks and crosses in this table, there is nothing simple about these rules. So I know there is a lot to take in on this slide, and may be hard to take in straight away, but I hope it will be useful reference for you to come back to. Broadly, you would note that with gifts, it's important to determine whether gifts are non-entertainment and entertainment gifts. So non-entertainment gifts are tickets to retail vouchers, hampers, bottle of wine. I specifically gave an example of bottle of wine because according to the ATO view, a bottle of wine in itself is not entertainment. And you can contrast it with providing entertainment type gifts, which are tickets to events, cinema, theater, or restaurant and accommodation vouchers. Those are entertainment benefits, and they have to be treated as part of your entertainment expenditure. So you will see in this table that I've gone through and provided treatment for not only FBT treatment, but income tax and GST treatment, because that's where a lot of errors we see in practice. And you can see how different treatment applies to clients and employees or their associates. And of course, when we doing this, we're assuming that an actual cost method is being used to value meal entertainment where applicable. Now, so when you prepare FBT returns, the minor benefits rule will become your best friend. But you need to understand and understand its scope. And more than ever before, the exemption for eligible work-related items will become important this year because of various items provided for employees to use in their home office. So take notice of these exemptions. Now, finally, what I want to leave you with is please take note that FBT, for FBT purposes, you always have to consider GST inclusive values. Please understand the difference between type 1 and type 2 classification. And I can't stress enough the importance of keeping relevant records and substantiation documentation. Thank you for your attention. And if there are any questions, we will address them. And otherwise, please reach out and we will be available to address any of your questions.
Yeah, look, thanks, Elena. And I think we've probably exhausted time for questions. We have answered a few questions through the control panel, but just reiterating, it was great to have everyone's support today. It was a really formidable attendance, so thank you. We will be making the materials available and the recording available, and they'll be sent out within 3 business days. To the extent there are people with some unanswered questions, we will address them personally. I think there's 3 or 4 questions left to resolve. I think Gary promised that we would be forwarding some further detail around COVID-related measures that we had in a bulletin late last year. So we will also make that available with the materials that we forward around. So look, thank you to everyone here. Thank you also to my co-presenters, Elena and Gary. If you do have any further questions, our email details and contact details are there. So please feel free to reach out. Otherwise, thank you everyone for your time and your support.
Yep. Thank you.
Thank you.